All right, we need to talk about investing myths. And I don't mean the harmless little ones. I mean the really dangerous ones. That common wisdom that gets repeated so often, we all just start to think it's true. Today, we're going to tear those myths apart and figure out what really, truly works.
And this quote, man, it just hits the nail on the head, doesn't it? Bad advice is sneaky. It rarely sounds bad. It's usually short, catchy, and simple. And when you hear it from everyone, everywhere, you start to believe it. But these little rules of thumb can quietly do some serious damage to your financial future.
See, here's the real kicker. Following this kind of flawed advice, it usually doesn't end in some big dramatic crash you see in the movies. No, it's more like a slow leak, a quiet underperformance that year after year just eats away at your potential growth. It's the wealth you could have built, but didn't.
So, to see this in action, we're going to unpack two really popular but deeply flawed strategies. They're on completely opposite ends of the investing spectrum, hoarding all your cash versus refusing to sell, no matter what.
On one side, you've got the cash is king folks. They believe the absolute safest thing you can do is stay out of the market. Then, on the other side, you have the diamond hands investors. Their motto is to never ever sell an asset, no matter how badly it's doing. Now, both of these sound like really disciplined, smart approaches, right? But they share the same critical flaw.
Okay, so for anyone who's not deep into internet investing culture, let's quickly define diamond hands. It basically means having extreme conviction. It's about holding on for dear life, never letting go, hoping, really hoping, that the asset will eventually turn around and skyrocket. But you know, hope is not an investment strategy.
And this quote just illustrates the problem so perfectly. It's such a great way to think about it. Just because you made a decision to get into an investment, to take that cab to dinner, doesn't mean you're stuck with it forever. If the situation changes, if the reason you bought it in the first place isn't true anymore, it's totally okay. In fact, it's smart to find a different ride home.
Okay, so analogies are great, but let's get into the hard data. This is where the real cost of these extreme ideas becomes so clear. Let's tackle that cash is king argument first. It feels safe, doesn't it? I mean, your bank account balance doesn't go down, but are you actually keeping your money safe?
Just look at this chart. This tells an incredible story. If you took $10,000 and just let it sit in cash back in 2009, today, because of inflation, you'd only have the buying power of about $6,600. You literally lost a third of your money by playing it safe. Meanwhile, that same 10 grand in a boring, simple S&P 500 index fund would be worth over $60,000. That is the massive cost of sitting on the sidelines. But the other extreme is just as dangerous. Diamond handing an investment can mean you watch a manageable 20% drop turn into a catastrophic 80% loss. Now sure, could this strategy work? Yeah, if you accidentally pick the next once-in-a-generation company. But way more often it just means you're locked into a losing bet, unable to move that money into something with real potential. So if both extremes are so flawed, then what's the answer? Well, it's not about finding another catchy rule. It's about finding a sensible, disciplined balance. Here's a really simple but powerful way to think about it. Step 1. Secure your base. Keep about 6 to 12 months of your living expenses in a safe, high-yield savings account. This is your emergency fund. This separates your safety net from your investments, and psychologically, that's huge. It helps stop you from panic selling when the market gets rocky. Step 2. Invest the rest based on your own personal goals. And Step 3. Realize that selling is a strategic tool. It's not admitting failure. It's for smart things like rebalancing your portfolio, managing your taxes, or just because the reason you bought something in the first place has changed. At the end of the day, this whole thing is about moving beyond what I call fortune cookie wisdom. You know, those short, catchy phrases that sound profound, but are actually pretty empty. So what's the stuff that actually works? It's not some secret slogan. It's actually kind of boring, but it's incredibly powerful. It's things like diversification, so all your eggs aren't in one basket. Keeping your costs low, so fees don't eat up all your returns. Patience, so you can let your money grow over time. And discipline, to stick to your plan even when it's scary. That's it. That's the real formula. And this really says it all. Good investing is usually pretty boring, and that's a good thing. It's about having a consistent process, not about finding the perfect one-liner or trying to time the market. So I'll leave you with this to think about. Take a good, honest look at your own investing habits. Are they really built on proven, timeless wisdom, or are they just based on some catchy rules you've heard? Answering that question for yourself could make all the difference. Thanks for joining me for this explainer.